Are you seeing signs of inflation beginning to increase?
We're seeing very substantial inflation. It's very interesting. I mean, we're raising prices. People are raising prices to us. It's being accepted. I mean, it's not.
In today's economy, inflation is a big concern that's making a lot of people worried. It's affecting different parts of society and causing a lot of anxiety. With everyone from regular folks to big companies, investors, and politicians talking about its impact, it's been a major point of discussion for about the past year or so. So in this video analysis, we're going to take a close look at different investment options and see how they perform when there's inflation. We'll break it down step by step and really dig into the details. I wanted to share this really interesting exploration that was inspired by the expertise of the legendary financial guru, Warren Buffett. It's pretty insightful. Wow, it's really amazing how at 91 years old, Buffett has such incredible experience and wisdom when it comes to dealing with inflation. I spent a lot of time going through a bunch of interviews with Buffett to bring you this detailed content. I dedicated so many hours to researching and collecting data. I really appreciate your support, so if you could do me a favor and hit that like button, it would mean the world to me. Thanks so much. Also, if you like the content, you can subscribe to the channel to stay updated on more insights. As we dive into this video, it's important to recognize that keeping cash during times of inflation might not be the best investment choice. This viewpoint isn't just held by Buffett, but it's also strongly supported by another financial expert, Ray Dalio. Dalio, who is well known for his financial expertise, has summed up this idea in a catchy phrase: cash is trash. The reason behind this is that inflation keeps eating away at the value of your cash reserves, whether they're in your savings account or stashed away at home. It gradually makes your money worth less and less as time goes on, day by day, week by week, month by month, and year by year. Hey, I really want you to understand something important from this video. It's all about the need to assess your investment returns in real terms. Calculating real return on investment is actually pretty straightforward. It's not as complicated as it may seem. Let's say you have an investment portfolio that gives you a 10% annual return. At first glance, it might seem like a pretty good outcome, right? But if we take a closer look at the current inflation rate, we might see a different picture. If you want to figure out the actual return, you just need to subtract the inflation percentage from the gross return. Let's say the inflation rate is 7%. In that case, your actual return would only be 3%, which doesn't seem as appealing anymore. Unfortunately, cash is not a great investment option these days. Its value keeps decreasing over time, so it offers very little return and can't keep up with inflation. Fixed interest rate bonds are considered a step up from cash in the investment world. They're often seen as a safe option following traditional investment theories. But Buffett disagrees with this idea, saying that we shouldn't assume these instruments are safe just because they seem that way. He believes that once we consider the effects of inflation, their safety might not be as real as we think. To explain it better, let's talk about the current yield on a 10-year U.S. government bond. Right now, it's around 1.8% as mentioned in this video. If you invest in that bond, you'll get a 1.8% annual return for the next 10 years. Well, if we assume that the average inflation rate will be around 4% in the upcoming years, which seems reasonable considering the recent 7% inflation statistics, then the annual real return, after accounting for inflation, would be about minus 2.2%. Well, it seems that while it's slightly better than keeping cash, it's definitely not a great long-term investment strategy. There's definitely room for improvement. Keep watching as we dive deeper into this complex topic, uncovering helpful tips and strategies to strengthen your financial planning during these uncertain times.
You know, if we dropped $1 million of cash into every household in the United States today, everybody would feel very good, except the people that invested in things that were denominated in dollars. And,
Exactly.
Yeah.
Exactly.
Absolutely. It's really important to understand that if you have assets like fixed-rate bonds, they might lose value when there's inflation. On the other hand, people who have taken out long-term loans with a fixed interest rate usually come out ahead when inflation occurs. You know, a great example of this is when people decide to take out auto loans to buy a car. It's a pretty common thing these days. Oh, let me tell you a story. So, back in January 2021, I got myself a brand new car. I decided to finance the purchase with a 60-month fixed-rate auto loan at a 3.5% interest rate. So basically, this agreement guarantees that my interest rate will stay the same for the entire duration of the loan. That way, my monthly payments will always be the same for the full 5 years. This situation is actually pretty good during times of inflation. This advantage comes from the fact that as time goes on, inflation slowly reduces the actual value of the loan, making the burden of the debt less and less over time. So fundamentally, because of inflation, the value of each dollar decreases over time. This means that when I repay my auto loan, I'm using dollars that are worth less, which actually helps me save money in the long run. Hey, you know what's interesting? Even during tough economic times with inflation, there can be a positive side. It's like finding a silver lining. It shows that borrowing money strategically can actually be a good thing for your finances in these situations.
If you own a home, though, with a very large mortgage and you have incredible inflation, it wipes out the mortgage, and you've still got the home. I mean,
in Weimar, Germany, they gave you the mortgage back at the end. Well, it's very interesting. That's the one thing they did right.
Now let's talk about what Warren Buffett calls unproductive assets when we're looking at investments during inflationary periods. Oh, this category includes things like gold, silver, and other precious metals that have their own special value. If the economy is experiencing inflation, it's not necessarily a bad idea to have these assets in your investment portfolio. Well, the reason for this is that, if everything else stays the same, these assets are expected to keep up with the increasing inflation rate. Essentially, when the prices of things go up, the value of precious metals is also expected to go up. This helps protect investors from some of the effects of inflation. But it's really important to look at this from a balanced point of view. Even though these unproductive assets have the potential to protect against inflation, there's no guarantee that they will actually increase your purchasing power. So, when people call them unproductive, it's because they don't actually make any money or give you any dividends. They just kind of sit there in your portfolio, showing their value without actually helping you make more money. Well, even though they might hold their value compared to a currency that's losing value, it's not very likely that they'll help you grow your finances or create wealth in real terms. Other investments that generate income are usually better for that. So even though they could act as a buffer to protect you, they might not really help you make a lot of money or accumulate assets in the long run. So if we want to really understand and maybe even appreciate how unproductive assets work, especially during times when the economy is unstable and inflation is high, we should check out what Warren Buffett has to say about it. Buffett is incredibly wise and experienced, so his perspective on this matter could give us a more detailed analysis and maybe even some strategies for investing in unproductive assets during inflationary periods. Let's dive into Buffett's incredible knowledge and expertise as he explains the nature and behavior of these unproductive assets in the complex world of investments, especially in a time when inflation is a big topic in the economy. Maybe his wisdom can help us come up with a strategy that takes into account both preserving and growing our wealth during these tough times.
I would say this about gold. If you took all of the gold in the world, it would roughly make a cube 67 feet on a side. So if you took all the gold in the world, we could have a cube that went down there 67 feet, 67 feet high, and that would be the whole thing. Now, for that same cube of gold, it would be worth, at today's market prices, about $7 trillion. That's probably about a third of the value of all the stocks in the United States. So you could have a choice of owning a third of all the stocks in the United States, or you could have a choice of owning that little block of gold, which can't do anything but kind of shine there and make you feel like Midas or Croesus or something of the sort. Now, for $7 trillion, there are roughly 1 billion acres of farmland in the United States. They're valued at about $2.5 trillion. It's about half the continental United States is farmland. You could have all of the farmland in the United States. You could have about 7 Exxon Mobils, and you could have $1 trillion of walking around money. And if you offered me the choice of looking at some 67-foot cube of gold and looking at it all day, maybe touching it, and fondling it occasionally, and then saying, do something for me, and it says, I don't do anything, I just stand here and look pretty. And the alternative to that was to have all the farmland in the country, everything, cotton, corn, soybeans,
7 Exxon Mobils. Just think of that. Add $1 trillion of walking around money. Maybe call me crazy, but I'll take the farmland and the Exxon Mobils.
Moving on to the next level of investment options in our analytical framework for dealing with inflation, it's important to note that smart investors are looking for ways to not only keep up with rising inflation, but also to outperform it, resulting in real and substantial returns. So let's talk about something important that Warren Buffett has identified as productive assets. It's a critical segment that we should pay attention to. As we go deeper into the topic, it's important to recognize the impressive career of Warren Buffett. He's widely known for his incredible wealth, which he earned through smart stock investments and buying entire businesses. He was able to amass a fortune mainly because he had a talent for recognizing and investing in things that are considered valuable and can make money. This type of investment is great for people who want to protect themselves from inflation and possibly make good profits in the long run. But here's the thing. Buffett wants to make it clear that not all businesses are the same. They have different qualities and potentials, which means they won't all be able to handle inflation and give you big returns. So in this situation, we're going to dive into the interesting aspects of what we can call regular businesses, among all the different types of assets that generate income. These regular businesses have certain traits that define how they operate and handle their finances. One big thing that sets them apart is their constant need for a lot more money to keep things going. They use fancy words like substantial additional capital infusion to basically mean they need a lot of cash to keep their operations going strong. Unfortunately, the need for continuous capital investment can sometimes make it difficult for these businesses to generate the best possible returns, especially when faced with inflation. Based on this, it's clear that when it comes to investing in productive assets, a smart investor needs to be careful and have a good understanding. They need to be able to tell the difference between businesses that just use up a lot of money to keep running and those that are skilled at turning investments into profitable returns. This is especially important when dealing with inflation. Buffett's wisdom is like a guiding light for investors who are trying to navigate the complicated world of investing during times of inflation. It helps them make choices that not only provide stability, but also offer opportunities for growth and success.
Unfortunately, most businesses will not come out well in real terms during inflation. Their earnings may go up a fair amount over time, but they're compelled to put more and more dollars into the business just to stay in the same place. And the worst kind of a business is one that makes you put more money on the table all the time and doesn't give you greater earnings. So
let's take a look at how investment strategies can be affected by inflation using a real-life example, United Rentals. It's a company that you can find in the stock market under the ticker symbol URI. This company has really established itself as the top player in the equipment rental industry. They've done it by keeping things simple with their business model. So mainly, United Rentals gets equipment that's mostly used in construction projects. They have things like bulldozers, portable restrooms, and heavy-duty trucks. So basically, we rent out this equipment to different construction projects for a short period of time, usually for the duration of the project. But it's important to understand that the equipment United Rentals gives you won't last forever. So you'll need to replace it from time to time. So let's say each bulldozer the company gets costs $1 million. Wow, this thing could make a whopping $1.2 million in revenue over its lifetime. And guess what? That means a cool profit of $200,000. Pretty impressive, right? So here's the thing. If the inflation rate were to jump up to 20%, the company would need to set aside a whopping $1.2 million to buy a new bulldozer. This shows how the profits they make keep getting put back into the business, without leaving any room to actually take money out as profit. It's a never-ending cycle. I agree that a 20% inflation rate might sound like a lot right now. It's tough for companies like United Rentals that rely on a lot of capital during times of inflation. They're doing a good job, but it's still challenging for them. Charlie Munger, who is Warren Buffett's esteemed associate, also shares this sentiment. he categorizes businesses into two distinct groups. There are two scenarios to consider here. In the first one, when profits are reported, they actually turn into surplus cash. This means that the business can take out this cash without any negative impact. In the second scenario, profits only exist as assets on paper, but there is no actual cash available to access. Moving on to another important aspect, let's talk about the concept of pricing power. Companies like Samsung, for example, have managed to build a loyal customer base who are willing to pay higher prices for their products, even if the costs go up. On the other hand, businesses that don't have this advantage are really affected by price competition. Take, for example, a company that makes plain white t-shirts without any special logos or branding. They have to constantly compete with other companies solely on the basis of pricing. In a situation where there's a lot of inflation, companies like these end up dealing with higher costs in different areas. The problem is that they can't raise their prices enough to keep up, which shows how dangerous it is to not have the ability to set prices when inflation is happening. As we continue our journey into investment hierarchies, we stumble upon something called productive assets. These are basically businesses that are really strong and have a lot of potential for big growth. So here's another idea to think about. Imagine this guy named John. Instead of going for those expensive models, he decides to invest a cool $2 million into creating a software solution that makes it easier for people to create content on YouTube. Pretty interesting, right? This venture not only makes a profit of $400,000 in the first year, but with the inflation rate of 20%, we can also increase the price of the software, which boosts the revenue to $88 million. This business model is really interesting because it doesn't require a lot of money to keep running. It's a great example of how businesses can thrive even when prices are going up. I'm looking for investments that can beat inflation without facing the usual challenges. This means focusing on businesses that don't need a lot of money to get started and have a strong brand like Apple or Coca-Cola. Even Warren Buffett's See's Candies could be a good example. Yeah, these entities, along with tech giants like Microsoft and Facebook, don't really depend on physical assets that much. That means they don't have to invest a ton of money in physical stuff to keep growing. Also, their ability to set prices, which is more of an art than a precise science, has the potential to handle inflationary challenges well. Hey there, let's think about how customers might react if the price of a product increased by 10%. Some customers might not really care and be indifferent about it, while others might straight up reject the idea and not be happy about the price hike. It's important for us, as discerning investors, to consider these different reactions. During times of inflation, it's a good idea to invest in companies that can easily raise their prices. That way, you can make the most of the situation and maximize your returns. It's important to avoid getting involved with companies and industries where prices are low and competition is tough.
And the best investment of all, I mean, if you're the leading brain surgeon in town or the leading lawyer in town or the whatever it may be, you don't have to keep re-educating yourself to be that in current terms. You bought your expertise when you went to medical school or law school in old dollars, and you don't have to keep reinvesting. And you retain your earning power in current dollars.
The best way to protect yourself from the negative effects of inflation is by focusing on personal growth and striving for excellence. When you become really, really good at what you do, like being an amazing mechanic, lawyer, dentist, plumber, or accountant, you become super important to society. Being highly respected in the business world gives you the power to set your prices and have clients happily pay a premium for your exceptional services. So that's the end of this enlightening segment, right? Did you find value in this content? Hey, if you enjoyed this video, I'd really appreciate it if you could show your support by giving it a like and subscribing to the Investor Center. Thanks a bunch. Don't worry. My main goal is to help you become a better investor by sharing the valuable insights I've learned from the top investors around the world.